I want to, at the outset, thank the chair and the ranking member for getting us to this stage on this bill. I also want to thank the co-sponsors of this bill. We have, just from the committee, some 13 Democrats and 8 Republican members of the Financial Services Committee to co-sponsor this bill, but I especially want to thank the original co-sponsors, Mr. Huizinga, Mr. Garbiano, and Ms. Bynum, for their efforts into bringing us to this point. This is a bipartisan bill, and like all of the most fascinating bills that come to the floor of the House, it deals with accounting. And like the most important bills that come to the floor of the House, it deals with accounting. In this case, accounting for the expense ratios of mutual funds. This bipartisan bill, H.R. 2225, the Access to Small Business Investor Capital Act, makes a narrow technical correction of the federal securities rules that had a major unintended consequences over the last 2 decades. In 1980, Congress created the business development companies to facilitate capital formation and get that capital to small and medium-sized businesses. I want to point out that as we've had tighter and tighter bank regulations, banks have been reluctant to lend money to small businesses except where their risks are guaranteed by the Small Business Administration, and SBA loans are, of course, limited. So we need BDCs to provide investment and to provide management assistance to growing businesses that are often underserved by traditional lending institutions. By law, BDC must invest at least 70% of their assets in small and medium-sized domestic companies. Over time, BDCs have filled that critical gap in our capital markets by funding businesses in industries and geographies often overlooked by other financial institutions. BDCs are often the first institutional investors to step in. This bill will play an important role in getting BDCs the capital that they then put into small and medium-sized businesses. Calculations are that $120 billion more will be available to invest by BDCs because we expect a 30% increase in total investment. That is because this bill opens the door to mutual fund investments in BDCs. Despite the success of BDCs, in 2006, the SEC had adopted a rule that inadvertently discouraged capital flows into BDCs, constraining their ability to serve small business. The rule, as part of the SEC's Acquired Fund Fees and Expenses Framework, AFFE, requires mutual funds and other investment vehicles that invest in BDCs to disclose as management fees of the mutual fund the expenses, the overhead of the BDC. This is in radical opposition to how similar investments are treated. So if a mutual fund invests in the bank, the mutual fund, of course, lists as an expense of the mutual fund the expenses of the mutual fund. But it does not list the overhead of the bank as if that's an expense of running the mutual fund. Banks and BDCs are 2 of the major types of institutions that make business investments and business loans. The double counting of BDCs by counting those as expenses of the mutual fund simply makes it impossible for mutual funds to invest in BDCs. The SEC rule artificially inflates the expense ratios of those mutual funds that choose to invest in BDCs, and so many of them don't. The result is misleading. Investors see a fund's expenses as higher than they actually are, simply because the fund decides to invest in BDCs. This perception has led many fund managers to exclude BDCs from their portfolio, not because of performance, but because of this distorted regulatory accounting. The intent of this rule, to provide transparency, was well-meaning, but the execution, when applied to BDCs, has been counterproductive. Research by U.S. international financial professors shows that BDCs were removed from the major U.S. stock indexes as a consequence of this misguided AFFE rule. And BDCs experienced a 29% to 33% lower investment growth as compared to similar potential investments. The effects were not limited to the financial sector. Companies that rely on BDCs saw lower job creation, with employment falling by between 1.5 and 6.5 percentage points compared to pre-exclusion levels. The rule also fails to recognize the unique structure and mission of BDCs. Unlike passive funds, BDCs are actively managed and intentionally incur higher costs in order to provide tailored investment and advisory services to the small businesses that they invest in. This model creates long-term value, but the AFFE rule unfairly penalizes it. This is, of course, a departure. The rule is inconsistent with the way the AFFE rule applies to mutual fund investments in REITs and, more importantly, the way it applies to mutual fund investments in banks. Because of this rule's miscounting, BDCs were removed from several stock indexes, as I pointed out earlier. If the SEC had the benefit of hindsight, I think it's unlikely that they would have adopted this rule, which contradicts the rule that they have for investments in banks and REITs. That's why Congress needs to reverse this. The Access to Small Business Investment Capital Act fixes this by allowing BDCs acquired fund fees and expenses from disclosures while maintaining transparency around the BDC management fees and costs. This restores fairness and aligns the regulatory disclosures with economic reality and gives investors a clear view of their actual costs. Importantly, it does so without rolling back investor protections or weakening SEC oversight. I want to point out that this bill will provide $120 billion of capital to our small and medium-sized businesses without a penny of cost to the American taxpayer and without any risk to the American taxpayer. This bipartisan legislation will open the door to more investment in BDCs, thereby unlocking capital for small and medium-sized businesses. The most important thing that our financial institutions, the most important thing that our capital markets can do is provide capital for growing American enterprises, particularly small and medium-sized businesses. Business development companies play a vital role, and I'm proud to work with a bipartisan group of members. As I pointed out earlier, we have a substantial number of co-sponsors, 25 in all, including 13 Democrats on the committee. We have seen bipartisan support for this bill, not only in this Congress, but in prior Congresses. This is the Congress in which we actually have to get it adopted. The bipartisan legislation will open more investments, unlock capital for small businesses, as I've said, and I would urge my colleagues to support this bill, and I reserve the balance of my time.